It's no secret that markets are a bit volatile these days and somewhat uncertain. What if we said to take a look at emerging markets in this environment? Want to know more? Well, stay here for another episode of UBS Trending. Hi, everybody, and thank you for joining us. My name's Anthony Pastore, and this is UBS Trending. Back in the studio with me for another conversation on the emerging market space is Alejo Czerwonko from the Chief Investment Office. Always good to see you, Alejo. Thanks for dropping by.
So happy to be here.
It's been a really interesting market. Of course, we're all keeping track of everything happening around the globe. We're tracking inflation. We're tracking oil prices and the conflict in Iran and other geopolitical events. But EM is certainly starting to take a little bit of center stage, especially as you're talking about it, and it's your world here. I think what investors are looking at now is this idea that historically EM has been sort of known as a little bit more of a volatile asset class than, say, developed markets, but it's shifting a little bit. Talk about that, because I think that's exactly the way we should get started with this chat today.
Absolutely. First off, let's review year-to-date market performance. Emerging markets outperforming developed markets across asset classes, currencies, bonds, equities. Even since the start of the war, emerging market performance is flat to up. I think few would have imagined a situation like this. There's a major war and emerging markets are outperforming. But to your point on volatility, if you look at data from the last 18, 24 months, you actually see emerging market assets quite often being less volatile than developed market assets. Concrete example, emerging market currencies, most of them, on average, less volatile than G7 currencies, such as the euro, the yen, the pound, right? So the world is changing, and many of the assumptions that have been long held in people's minds need to be revisited.
So I guess it's an interesting part of this story. What's behind the shift, however? Because initially, you would think, well, there's so much volatility globally in the geopolitical world, and markets are very uncertain. No one really knows exactly what's going to happen next in this conflict or anything else in the world. What's behind the shift? Why is EM started to become the less volatile asset class? What's behind it?
Yeah, I think, we talked about this in prior episodes. Emerging market countries are maturing. They're more stable from an economic perspective. And going back to currencies, one of the reasons why emerging market currencies have behaved better in the last 18, 24 months has to do with credibility. Think about their central banks. They're independent, they're professional. And very recently, we saw the COVID-related inflation spike. We all suffered from it, but it was emerging markets that moved first, moved aggressively, therefore earning inflation-fighting credentials that many other central banks simply didn't. Think about the Fed and how there's criticism these days about, hey, you didn't move early enough, and might you be making a similar mistake again now with the ongoing Iran war?
Well, if you're looking at, that's a very important point. And when you're looking at the developed markets, there's a lot of policy swings. And again, that uncertainty word just keeps coming up. Anybody who sits in the chair that you're in agrees. Yes, obviously, there's a lot of uncertainty, which is, by the way, working with a financial advisor at UBS and listening to people like you is really important, and having a diversified portfolio. But when you think about policy shifts, unexpected, perhaps movements with central banks, how does that change the risk map for global investors?
Yeah, I think you make a good point. Not only have emerging markets matured, you're seeing developed markets in many instances behaving more like emerging markets.
Right.
Concrete examples, elections in the US, in the UK, in France, in Japan, didn't used to matter as much as they matter today. And that's because they carry with them very sizable changes in policymaking, right? That didn't used to be the case. There used to be more consensus about where countries should go, and now there's very sizable divergences between the left, the right, the center, what have you. In addition, Anthony, we are living in a multipolar, in a fragmented, in a conflict-prone world, and I think this is simply creating an environment that just engulfs developed markets, emerging markets, everything, all of the above.
Yeah. And you look at countries like India, for example. We've talked about India quite a lot. It is a very exciting country to keep an eye on because how much it's developed. One of our colleagues, Sangeeta, went there for a wedding, and she grew up there, hadn't been there for like 20 years, and when she went back, she said she couldn't believe how much it had changed in development. In Mumbai,
Yes.
she said the amount of commerce and buildings that went up. She said it was almost unbelievable to know that she was standing in the same spot she was when she was a child. So countries like India are very exciting, and there's a lot of development there. But here let me ask you this question, because if you look at EM right now, where we are with this slightly less volatility and good performance, is there anything that could knock it off that pedestal to make it to potentially become more volatile again? What do you think that looks like if that were possible? What is that? How would that even happen?
With emerging markets, you got to track very, very closely global financial conditions. When money is tight, that's a problem. Right? And we're living in a relatively easy money backdrop as we speak, war included. Interest rates are relatively low. Equity markets globally are at all-time highs. So financial conditions are generous. If financial conditions become more tight, that's something to worry about.
Okay.
Number two, relatedly, the overall direction of the U.S. dollar.
Yeah.
If the U.S. dollar depreciates,
it's been weak.
Even with the war,
Yeah.
the U.S. dollar has gone nowhere. It's shocking,
Yes.
right? Historically, you would have expected war, flight to quality, flight to safety, dollar appreciating. That hasn't happened this time. So the world is changing. But I would track global financial conditions, the overall direction of the U.S. dollar, and commodity prices. Commodity prices have been going up.
Absolutely.
Many emerging markets benefit from that. If commodity prices were to go down, that could be a challenge, a headwind to emerging markets.
Right.
Those three are some of the key ones.
Right, and thank you for saying that. And I also, we're looking at some countries, developed and emerging, starting to use their own currency to pay for oil, which has been a U.S. denominated purchase since Richard Nixon. So it's that shift is starting to happen here and there. So it's a little bit of a global pivot, like the axis is starting to tilt.
Yes, that's true. You got to think about a world in which the dollar remains at the center of the global financial plumbing. It's not going anywhere because there's no credible replacement. But at the margin, countries are thinking more creatively. How do I manage my international reserves in a more diversified manner? So thinking about more currencies, thinking about certain commodities. That's why gold has been doing so well, and we think it will continue to do well.
So that move really probably hasn't surprised you all that much, knowing that you are deep in the data.
Well, the magnitude did surprise us. The overall direction is something that we were expecting.
Right. So let me ask you, before we wrap up, Alejo, what's the bottom line as investors are watching us have this chat? Where do you recommend opportunities, country-wise? Where is it equity? Is it debt? Where do you see the best opportunities right now?
I think the bottom line is many people are still stuck on the winning recipe of the 2015 to 2024 period, which was, I'm going to only look at the United States, and I'm going to only look at technology within the United States. That recipe might not work as well in the next 5-10 years. You got to broaden the aperture, you got to diversify geographically, and you got to move away from a mindset that only focuses on bits, that is software intangible, to more atoms, that is hardware tangibles, right? So, and that's a new mindset. You gotta, just have exposure. Emerging markets can help in that regard. We rate both emerging market equities and emerging market bonds as attractive in our global portfolios.
Excellent. Alejo, thank you very much. Good stuff. Always great to have you join us. And this time, we really did have to kind of take a big picture look at EM as things are consistently shifting in that space. So looking forward to having you on again next month. Thanks for coming by.
That was great.
Yeah, excellent. Alejo Czerwonko from our Chief Investment Office. And thank you all for watching. And make sure to check out our Insights website at ubs.com/views for more CIO intellectual capital and thought leadership. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, UBS Studios has its own Instagram channel. Follow us at UBS Trending. Lots of content there for you. And as always, please, if you have any questions or want to continue this conversation, make sure you're doing so with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon. Thanks.